Welcome to Helpline. It's Saturday again, and I'm here to answer your questions. I'll start with questions straight away. Nitin Lodha has asked that while doing the consolidation of portfolio, is it recommended to invest the amount from existing funds to a selected set of equity funds in a staggered manner, or will it be okay to move the money at one go? This is what I understand, though the two parts he has written looks like the same. Yes, you can, if you have decided on the target fund and you have accumulated your savings and averaged your investments, yes, you can well do that. But gradual investment, is always basically a tool to manage your anxiety or, not catching a market high. But you are already invested and you are just consolidating, and the only problem that you have to overcome is that you will be taking your money out and investing, and don't get trapped into get anchored to the value that your money that was invested gradually, or you have accumulated something like 5 lakh rupee, and you move your 5 lakh rupee, and tomorrow when you see it 430 or 450, you'll think that your 5 lakh has been reduced. We get anchored to the value. Overcome that. Think of it as because that the same thing can happen with your existing investments too, but you will be not anchored there, because you will think that you have invested gradually over a period of time, and your cost of these units will be different as compared to the ones which you will be buying it. So yes, you can move your money at one go. Don't get anchored to the value at which you will be moving your money. Amit Sharma is asking that last week my company settled my account and sent me the balance in my account. After serving for approximately 27 years, I had to leave my job due to health issues. I am 53 years old. How do I invest this amount, which is around 50 lakhs, so as to get optimum return by the time I am 60 years? I don't know. I require some more information, which is, will you be working for next 7 years? Will you be requiring income after 7 years when you turn 60? Or whether because of health reason you have you had to leave your job. So will you be taking up a new job, or it's some other reason why you had to leave your job? So it primarily depends on when do you want to derive. A plan must be based on whether you want to derive income from your investment, which is 50 lakh rupees, or at a future date when you turn 60, that is 7 years from now, and then you require the income from your investment, and the plan will depend on that. But anyway, I would say that few principles which has to be followed at all times whenever you are investing for income in your retirement from your capital, which is spread your investments. You have this large sum of money, spread this investment not less than a period of 3 years. Don't try to speed up your investments. The money that you require in the first 3 years should be kept in a fixed income fund, and you should do a systematic withdrawal plan from that fixed income fund, so that you don't have to worry about deriving income from tomorrow itself, and that fixed income fund will take care of your income requirement in the initial period. If you do these two things, and for next if it is a situation that you have to invest this money and for 7 years for 7 years the money can grow, then also I would suggest that spread your investment at least in a period of 1.5 to 3 years. Invest in a balanced fund or a multi-cap fund, and one or two balanced fund or one or two multi-cap fund. And when you need income, make sure that you are withdrawing money which is not exceeding 6% of your accumulated capital. And that will also require a periodic adjustment in terms that you take out 6% of your accumulated value when you start deriving income, and revise it annually. If the capital has grown, you should be able to revise it upward, and if it has come down, revise it downward, because that is the only way so that you don't eat into your capital more so when markets are unfavorable. The other is that this is the only method through which you can be assured of inflation adjusted return over the long term, because if you put all your money in a fairly risk averse manner only in fixed income, then you run the risk of outliving your savings. That will be very risky. Anand Patel is asking that when will value research premium be made available? Eagerly waiting for it. Can you please give? Would it be prudent to consolidate funds at this time from 10 to 4 funds? One multi-cap, one contra, one mid-cap, and one debt and equity. We are working very hard on launching value research premium. Many of the features are under testing right now. I think few more weeks, and we know that we understand that you have had to wait quite a bit for this because we launched our we relaunched our site, and it has been nearly 5 months that. But we struggled with the launch of our site. That took some time, and then this pandemic, which has affected in a limited way the speed at which we were working. It could have been a little faster, but few more weeks and we will be ready to launch, and you'll be first to know. I know that you have also registered your intent to subscribe. So thank you for your patience, and few more weeks will be there. Your key question that should you consolidate funds at this time? I think so. It is always a good time, more so in times like this, because the way the investment values collapsed and now they have steadily recovered reasonably. I would say that it is always a good time to consolidate your investments in a manner you desire, with the understanding that you are doing it with a purpose, and the plan that you have laid out looks good. You are getting representation of the market, you are diversifying meaningfully. Make sure that these 4 funds are of different fund families, because I find that the style generally spreads across different kind of fund of the same fund family. For example, the debt and equity fund or the multi-cap fund, the equity preferences will be somewhat alike. So at least you'll be drawing in on diversity of style will also come into play. Adding one contra, which has been a struggling category as such, contra and value fund. I think having some allocation to that is useful, because that is one part of the market. As in, sometime it has to turn around. They look very compelling, and but it has been a test of patience. It's a very difficult thing to do. Because we have not seen any performance there for a while now. So, but what you are thinking of doing is a very methodical thing. Do it. And you can do it. And what I was saying is that it might be a good time because you will have low capital gains tax implication, because now we have to pay 10% capital gains for our holdings which are over 1 year old since February 2018. So from that standpoint, you don't have to worry much about the capital gains, and you can make all those adjustments and realignments quickly without worrying about tax implication. But nevertheless, also be conscious of the short-term capital, the exit load which will be applicable for your investments which are less than 1 year old. CB Malik has asked that I want to invest in silver or gold. Is it proper time to enter when they already had a bull run? If yes, when is the easiest way to invest, and how do I track my investment? Yes, you can invest in gold, but is it the best time? I don't know. The best time to invest in gold was 1 year ago. And gold, we might think that gold is, of course, gold is a store of value. And of course, there are multiple ways in which you can buy gold. The most popular form is the jewelry. Then you can buy it from the bank in terms of coins and bars. And then you have the gold funds. And now you have another option which seems most rewarding or most attractive. Of course, it's a compromise on liquidity, which is the sovereign gold bonds. It earns you 2.5% more than gold. It has no management fee. All other forms of gold, it has an overhead. The jewelry has the making charges, which sometimes could be very substantial. The gold funds, the gold ETFs, they have expense ratio, and there could be a premium or discount when you go about buying it, and you also have to pay brokerage if you are not with a discount broker or the zero broker. If you buy the gold fund of fund, there will be a management fee over and above the underlying cost of the ETFs. So the sovereign gold bonds, they earn you that. Not only that, all the gains are actually capital gains exempt. Is treated. So that is the tax treatment is also very beneficial. The only problem is that if you want the money in the interim, because they come with an 8-year term, so you have to worry. But that is the finest form of gold. Now comes to, should you be investing in gold? I don't think gold is an investment as such. It's a store of value, and it comes in very handy. It does very well in times of crisis, when there is anxiety all around. Everything else is, there is a great risk in all the markets that we have witnessed, that we are witnessing. Gold comes to life. People run towards gold, and that might be, and that is the reason why you can have some allocation to gold. Look at it not as a performing asset class or as an investment. Invest in it gradually. Think of it as an insurance for your portfolio. That is the only thought that comes to my mind. Not as a performing asset class which will enhance your return. The reason why you are looking at gold because it has done very well over the last 1 year, that may be the wrong reason. The reason is that gold will actually never go down substantially the way equity can, or the way sometimes fixed income also, if faced with a default. So that should be the reason. DP Singh is asking that in view of the uncertainties in the debt market, will it not be advisable to invest all your money kept for putting in fixed income avenues in Bharat Bonds? Yes, Bharat Bonds, the ETFs and the fund of fund which is mounted on that looks very attractive. These are AAA bonds issued by public sector companies in a structured manner with very low cost. So they look very safe. Also, they are relatively new. And but you have to keep in mind that, and they are available in 2 formats. One has a 3-year term, the other has a 10-year term. If you are investing for these terms, think of it in terms of buying and holding it till maturity, because they come with a maturity. They will expire on this day. So you will be able to realize the yield on these funds, this fund, if you hold till maturity. And in the interim, right now, because they are less than 1 year old, 6-7 months old, they have witnessed, they have clocked some capital gains. So there is a greater appreciation. But if you hold till maturity, it will realign with the yield of the fund. Likewise, the reverse will also be true. In the next 10 years, we will, another 9.5 years for the 10-year term fund, there will be a situation that interest rates will go up. And that is when these bonds will actually also go down in value. When they go down in value, then also you have to hold on, like the way it has gone up, and you have to hold on to earn the return, which is the yield on the fund, till its maturity. So don't get perturbed by the interim decline in value or growth in value. But think of it, and on the quality front, the reason why you're asking this question, that we see great deal of uncertainty in the fixed income market, great deal of risk aversion. We have seen the Franklin Templeton episode where 6 funds had to be stopped, and now it is under litigation, and investors are under tremendous stress. That has caused the added scare, the fear. So from that standpoint, yes, public sector companies generally as an equity investment may not be attractive, but public sector companies, the bonds issued by them, precisely for the reason that they're a high quality company, they have good cash flows, they're government backed, or they're government owned, and they're AAA, and they are mostly in the commodity or those sectors where the cash flows may still be there. So yes, you are right. Bharat Bond ETFs and fund of fund could be an attractive option. Just mind that you are investing for the term which matches with the maturity of the fund. RJ Shah is asking that can we get mutual fund rating for all past or previous years? We have all the ratings, we have all the historic rating, but our website interface does not provide a mechanism of enabling. We do not show the historic ratings of all the funds, which sometimes could be a very long period, but we'll try to, as we are launching our premium version for all the sophisticated investors like you. discerning investors who are wanting to have more information, more analytical inputs, we will try and enable this piece of information in our premium version. Right now we don't have. Ganesh Siv Prasad is asking that the stock recommended by stock advisor can be bought as a monthly SIP and need not be monitored closely. Would starting another mid-cap SIP make sense? If you can actually, today it is possible, and you are an active investor, you are paying us a fee for getting those recommendations. Why not do it yourself? You will save on the expense ratio, you will own the decision, and I think you won't be disappointed. Some of our, we have a good collection of mid caps too in our stock recommendation. But just in case, if you want to have simplicity, if you want to have a small part of your money, which should be on a structured investment program, then by all means add a mid cap SIP. But I think the kind of active investors, the investors who graduate to subscribing to stock advisor, they should take a little bit of effort, and it's possible to have even small SIP equivalent money to be regularly invested in stock, say 4 or 5 of them, and every month maybe choose 2-3 stock which are relatively cheaper or have come down, because the stock universe, the universe that we recommend on stock advisor, or investing in all of them may not be possible. But you can opportunistically or be selective with some of your stocks and keep regular investments in them. And anyway, when we are recommending stocks in stock advisor, we are expecting you not to buy these stocks and sleep over it. We are expecting that you will be investing in these stocks over a period of time steadily. Make a short list of stocks that you would like to invest. We have given our short list as well, which is the best buys now. We keep reviewing it more often than we make recommendations or make changes. So investing in those may be a possible idea. And today it is possible, the online trading, the way it has taken off. You can buy small units, 1 or 2 share, buying 1 or 2 share of many of the stock is also possible. Mr. Vittal, NV Vittal, is asking that I have subscribed to Value Research Stock Advisor and I found it very useful. Thank you. My suggestion is, if you can recommend the maximum buy price for the stock so that we do not overpay over the recommended price. The max buy price can be updated periodically when there is an update. Thanks. Mr. Vittal, I can assure you that whenever a company's stock price, that will be one of the reasons. If the stock price actually goes to a point where we think it is unsustainable, it has gone past way beyond it has got disconnected with the fundamentals. It has become very attractive. It has become very expensive. We will recommend a sell recommendation. But at the same time, there has been many investors have been asking us to give us a price range in which to buy. Many of these stocks which we recommend on the basis that these prices will go up, given that they are relatively attractive besides being a good company, a growing company, a well-managed company. So those validations we do very rigorously. But there are situations, we don't get hyperactive on that front, because if we think that the reasonable value of a stock price of a stock is 100 rupee, and if it has gone up to 120 rupee, we may not recommend a sale. Because with rising fundamental, if rising earnings can support or can justify or defend a higher price, it may the stock price may keep moving up and backed by rising earnings, and it may never be a sell, and you will keep making money. If you look at all the great stocks which have been able to sustain their earnings over a long period of time, their stock prices went up, so did their earnings. In fact, earnings went up and so did the stock price, and it kept going up. And if price going up may not be the reason to sell a stock, but I take your advice that there are times when stock price may be to a level which may not justify investment, maybe continue holding, and that is the time. But and we will try, and at some future time, we are not very actively looking at it, but we will consider your suggestion very positively. Senthil Murugan is asking that I'm expecting the market will fall when the earnings come out. Most of the company is going to show negative results due to the pandemic. Do I need to stop my SIP in Mirai Asset, emerging blue chip as well as SBI small cap funds to protect my capital that I was invested for last 5 years? And the problem is that you may be right and you may be very wrong. And the problem is also that your whole framework, you may be right that the earnings will come down, but you may be wrong that stock prices will also come down. I'll tell you the reason. The reason is that we expect that the earnings will come down, but the market is very optimistic also, because market thinks that this is going to be temporary. It will be for 2 quarters, it will be for 3 quarters, it will be for 4 quarters. And prices are down by 10-15% even now from the pre-COVID levels, stock prices, or the levels of the index that you see. And after that, the market has made a smart recovery. So I would say that don't do that. That's the idea for behind this. If at all you do it, you may be right, you may be wrong, and it will translate into a big missed opportunity. And markets keep surprising us. So I would say that diversify, have control what is in your hand, which is diversify your money, be regular with your investment, do your asset allocation. If you think that your accumulation in the last 5 years is entirely into equity, maybe build a 20% fixed income allocation. Bring in your disciplined rebalancing principle to be implemented every 6 months. If you do that, you'll be able to do it with some method. We have absolutely no control on the level of the market, when it will go up. Yeah, and your theories may be right, or it can go wrong. So don't do that. Bring in your asset allocation, diversify beyond one fund, and keep your SIPs in that ratio. Sunil Kumar is asking that due to COVID-19 crisis, there is a salary cut of 25%. I have ongoing monthly SIP of 1.55 lakh, which I want to reduce to 1.3 lakh, 1,30,000. Please suggest which mutual fund should I pause. I have a mix of small, mid, multi-cap, large cap, and sector funds. My investment horizon is more than 10 years, and has been investing for 10 years. If you have been an investor for 10 years, you understand that the long-term, the rewards of long-term regular investment. It requires, sell your losers. And but I would say that before that, sector funds are opposite of, they are concentrated bets. They are meant for a vehicle of targeted diversification, that you don't know about a sector and you are very excited about a sector. And but in most cases, I think for most investors, sector funds may not be there in their portfolio, because if you are having multi-cap, mid-cap, small cap, contra, and all, a combination of 4, 5, 6 diversified funds, there is absolutely no need for a sector fund, because when you have entrusted your money to a fund manager who is actively managing your investments, he will get in and out of sectors. That is a responsibility that you have delegated. Unless there is a sector which is otherwise not represented in your portfolio. But I don't find too many such sector funds in India, which is making accessible a sector which is otherwise not there in any equity portfolio. So first, get rid of your sector funds from your SIP allocation. And after that, I would say that sell your long-term losers. Mind you, long-term losers. Not in terms of last 6 months, 1 year, 1.5 years, what has not done well. Because if you do that, then you will actually get rid of the small cap, which might be a promising allocation, but it has faced bad weather over the last 2-3 years, and it will keep you rewarding if you continue investing through the lean times. So sell your discontinue your long-term losers after sector funds. Supriyo Majumdar has asked that I'm a subscriber of Value Research Stock Advisor Services since its inception in 2017. and I've invested in almost all the stocks recommended. Currently, it's over 49 stocks in my portfolio. So I'm wondering how value research stock advisor services are different from multi-cap mutual funds. In longer term, how return will be different from mutual fund. I hope that we are able to beat or match at least the top quartile multi-cap manager, and we are not very disappointing so far. We have had our successes and we have had our failures. But one thing I'm very assured of, that and still it is not even 3-year-old service. It might be a little too early to proclaim any success. But I would say that one thing you should do is that you should follow the sell recommendations that we have also made. If you have 49, then maybe one or two sell recommendations you have not followed. Sell them, because with great difficulty, when we regret making a sell recommendation, but things become unfavorable for a company, and we give up hope that this company has lost the charm based on which we recommended it in the first place. Those variables are no longer there, or those are no longer visible. So the outlook has changed. So sell the stocks that we have recommended sell. You can also exercise some selectivity. I would say that when the whole premise of devising value research stock advisor was that you will learn, you will read the thesis of our company, you will agree with many of them, but you may disagree with many of them. The ones you disagree with or you don't feel very convinced, have smaller allocation, don't invest in them. Emphasize your money in, so that way the stock advisor will be a useful tool to help you invest better. We will do all the hard work in terms of keeping an eye on the company, keeping you update on each and every result, forewarning you on anything which is dramatic happening to a company, favorably or unfavorably, and more so, the big moves update that you get on value research stock advisor is a very useful thing, because most of the time we miss a big opportunity if the stock has seen a big decline. The stock price collapses and many investors actually run, but it may be for a temporary reason, and that is when we think that we play a very good role. Also, on the reverse, that a stock price of a company goes up dramatically and it holds a long-term promise, but simply because the stock price has gone up so dramatically, and 4 or 5 stocks in our recommendation have gone up. In fact, they have gone up so dramatically even in this pandemic period, that sometimes we think about among ourselves. Every few days, all the stock analysts have a discussion about what is going on, and when we look at the stock prices, the way they have gone up, even during this period, sometimes we are tempted that is it over for this stock? Is it too pricey now, or what is going on? And we take a measured decision that this may not be a good enough reason. Stock prices going up, generating substantial return in a brief period, may not be a good enough reason to actually get rid of a great company in your portfolio which may have miles to go. And some of the best performing stock in the last 10, 15, 20 years in India are the ones which were very, very expensive. They went up and they kept going up, and they never came down. And once in a while, if they come down, some investors, if they get out of it, they never get an opportunity to get in again. So these are the critical roles which we want to play with your stock you using the value stock advisory. So invest with confidence, reduce some of the holdings, read little more, get a little selective, and I'm confident that we will beat or we will match a multi-cap fund manager. But allow us some more time. Allow us some more time in the sense that 2.5 years or little less than 3 years is not good enough for us to proclaim victory or be boastful about it or be disappointed about it. I'm thinking of a 5 to 10 year time frame when we can proudly claim or be very disappointed and cut a sorry figure. But before that, I'm apprehensive. I don't really want to take the credit or take the flak. Ankit Upadhyaya is asking that he's asking for his father, where should a retired person invest from his pension? He has 20 to 25,000 every month, which he wants to invest. He has actually asked, he wants to utilize towards this. Yes, Ankit, I understand that your father has a pension and he is able to save 25,000 rupees even from his pension. So these 25,000 rupees are long-term investment, or maybe a medium-term investment. And I would say that two things towards that. If his pension income is taxable, then he can still invest in tax saving funds and save up to 1.5 lakh rupees deduction on his income. 1.5 lakh rupee investment in tax saving fund will reduce his tax bill. So if he's a taxpayer based on his pension income, his first stop should be 1.5 lakh rupees in a tax saving fund. If that is not the case, then all the money should be invested in a balanced fund. All the money should be only reinvested by way of SIP, and that's it. It's simple plan: tax saving or balanced fund. Arun Shivaswamy is asking that over the last 5 years, I have lost about 25 lakh rupees doing trading, investing and intraday, mostly intraday losses, but also have made some profit which are sizable, but this huge loss is hitting me hard. Can I recover my losses in the upcoming crash? If so, which is the best way forward? The best way forward is that you have come at the wrong place. Value research cannot guide you to any of this. If you are in a hurry to recover your losses which you lost in intraday trading, we are a strong disbeliever in this whole thing. It is a matter of luck. And in fact, stock exchanges have become a vehicle of enhancing, democratizing speculation. Because investing and speculation has a very small line. You have the moment you buy a stock and you think of it in terms of becoming an owner and you're holding it for the long term, you get angry when the management does something messy. You feel happy when the company is doing well, and that is why the stock price steadily goes up. That is what value research, that is how value research thinks. That is how people, analysts at value research think. What you do, it requires instinct. I'm not saying that all traders lose money, but trading is a different thing, and we haven't really, we haven't come across too many wealthy traders who could sustain their wealth unless they do it at a very different scale. But I would say that we really can't be of any help to you. Ashutosh is asking that, would you expect a correction in the broader market in the next 3 to 6 months, which can present a good buying opportunity for the long term? Possible, but greatly impossible at the same time, simply because, and so the fact is that we don't know. And there is no reason why I could, I've been thinking, I've been worried, I've been quite surprised by, many stocks which made such a comeback in a hurry. And then I've been talking to some people, the market men, some fund managers, and they say that the market thinks that, some of all the earning losses that we see for the companies which are in the lockdown, or the reduced demand, or the reduced production, or the reduced supply, or the reduced services, it's a temporary phenomenon. And there are companies which will be hurt in a fairly permanent way. So in that sense, there will be difference in the number of companies which are making a comeback, the companies which will not make a comeback, or the companies where their earnings potential will be impaired in a fairly permanent way. So I would say that I don't know. I would configure my strategy so that I'm over and above this, and I will have some plan that maybe have 20% cash, so that if it comes down, I will invest. But the real problem is that when it comes down, we get even more fearful. Write your formula at what decline, what percentage of your cash you will deploy, if you have some cash, and definitely, and even then you will have regret, because once you invest and the market can go down further, and can remain there for a long period of time. So I am a stickler to some rule which one has to follow, otherwise mind changes with the market. And if you have a mind which changes with the market, then you will be prevented. There is a possibility that you will never invest again. You will be saved from investing. So get onto some plan and stick to it. Joydeep Ghosh is asking that how does expense ratio for particular mutual fund is putting an impact while I'm choosing any direct mutual fund through SIP. Everything else being equal, a fund with a higher expense ratio will get you lower return, assuming a fund generates a return of 20% and another fund which generates a return of 20%. After expenses, one which has higher expense will give you lower return. Though the NAV that you see is after adjusting for expenses. So I would say that if you have chosen 3-4 funds which you like, and within that if you have to filter 1 or 2 of them in which you will invest, go for the lower expense one. It will generate more return. But a lower expense can also be a function of the size of the fund, because the SEBI mandated formula actually reduces the expense ratio which a fund company can charge. Fund gets bigger, they have to charge lower expenses. And when a fund gets bigger, its ability to beat the market also reduces because it loses on its maneuverability, its flexibility. So there could be a compromise. So performance or the portfolio or the reason why it is performing or sustained performance should be the primary reason why you should choose a fund, and expense should be an added filter. Krishan Saharan is asking that ITC has been a great stock, giving decent return year on year. However, since last few years, despite very good reviews from every analyst, the stock has been beaten down for a long time. And what is my view on ITC at the current levels? Should we keep invested, buy more, or exit the stock? I'm little tempted to reveal my views on ITC, but generally I would avoid talking about individual stocks because that is how we make a living on Stock Advisor. But nevertheless, ITC has been a great stock. There are reasons why it has been a drag. It has dragged in its performance has been poor. 2-3 reasons. One is that ITC is a very large company and a huge market capitalization. So all kind of investors must like for ITC to stock prices to go. Yesterday's ITC gave a dividend of 10.5 rupee per stock, which at its current price is nearly a 5% yield. So a company which is debt free, a company which is a leader in cigarettes, which is very addictive and has a captive consumer base. It has made inroads into the FMCG business. It has made capital investments in areas. Its hotel business, people say that has been a poor capital deployment, but the management has gone on record. Now what they are saying is that they are not going to allocate any capital further. They are going to give 85% of the cash flow by way of dividend. So, but there is another reason why ITC has been a drag. ESG has been a very significant, environment friendly company, and tobacco has been out of favor. Has been a very strong reason why global investors, kept away from that. And in that sense, ITC is, so quite a few changes, and these are the reasons why ITC has been a drag, has been a poor performer. Maybe times will change. And when there is a company which has so many strong variables supporting it, and it is out of favor in the market for some technical reason or some variety of reason, or or because of large float in the market, many investors have to think very positively about ITC to be willing to pay a premium. It definitely looks like a value stock. So I would say that, and I don't know when it will turn around. There is a possibility that it might take longer, it might take some time, or it might take a very long time, or it might be a brief period. But when such a thing happens, when market realizes it, all the big turnarounds happen in a very brief period. We have seen that, and the other reason why ITC has been relatively out of favor is that the appetite for high quality consumer businesses commanding a huge premium for their growth is and investors are willing to pay 70, 80, 90 P for some companies which are growing much faster. ITC has not been a fast grower in that sense. Maybe as they are through with their investment phase and the return on equity looks impressive, some of the business might gain momentum. Things could be different. So have patience. These kind of investments take a very long period to fructify, but when they do, they make it big time. Another question, Gomati has asked that I have realized that I'm a passive investor with low risk appetite. I'm looking for a steady growth with a payout over 10, 15, 20 years to cover my child's education, my partner and my retirement. What are some safe bets for continued investing for low risk passive investors like me? Very low risk. Think of equity savings fund. They normally have a third of the money in equity. But I would say that 10, 15 and 20 years time frame. Be risk averse, manage your risk with your behavior, choose a conservative equity investment. I would say even a balanced fund could be a decent bet. Choose one or two balanced fund, keep investing, because that is the biggest hope in terms of deriving a good part of what the long-term return that equities can generate. Fixed income are going to yield even lower returns from here on. So it may not really, and possible that, our individual inflation need, our inflation is very different from what the government discloses or, government calculates, the wholesale price index or the consumer price index. The inflation on that could be very different from, our inflation in terms of what is our going to be the cost of connectivity, what is our commute cost, what is our traveling cost, what is our cost of living. Our living cost can vary very differently as compared to the inflation number that we see, and interest rates will be very much aligned to those yardsticks. That is a different matrix. So in that sense, having more and is always important, crucial. So I would say that invest in a balanced fund. 10, 15, 20 year time frame is a time frame when you will not be disappointed. And because these are also staggered over a period of time, 10, 15 and 20 years, when you have your interim goals, you won't be disappointed. And you run the possibility of having much more than you need, which is a great situation to be in. Because that's the only thing which we can prepare for, having more than enough. Because if you are going to have enough, then any calamity in between, any accident in between will actually reduce your margin of safety. So your margin of safety is having little more than enough or substantially more than enough. And with 20 years time frame, 15 years time frame, you have that possibility. Take your chances. And the way to manage your risk and being passive itself is a great risk management tool. If you are not looking at your investments every day, if you are not losing sleep by looking at the investment value every night, you have conquered half of the battle. So that itself can take care of it. Malabar 96. Okay, I just have his mail ID, MALABR 96. If we are not satisfied with the services of our financial advisors of late, though we are with them for a long time, is it advisable to switch to a different advisor? Yes, absolutely. You are paying for his services, and if you are not happy with any service, you should get rid of that service provider. We do it with all kind of service provider. Just this person happens to be a friend over a period of time, doesn't mean that you can't hold him accountable. Ask him those questions which is making you uncomfortable. It is good to have an old friend and get an answer from him. Be blunt about it. And if you don't get a satisfying answer, stop dealing with him. And then look for a new one. But at the same time, if you understand your advisor and the rationale why he recommended, because I find that many advisors do things with good intent, but many a times something goes wrong
they actually, they evade. They don't face you. They don't, and sometimes they're embarrassed. So being open about this discussion might be helpful. He may not be a bad advisor, just that he has become evasive after a recommendation which has turned bad. So try and fix him. Try and get him on fold. And if he's unable to, then after that, after you're dissatisfied and decided to fire him, then you should do 2-3 things. One is that what do you expect from your advisor? Enable transactions, or give you advice, give you great recommendations. And do you have alternatives? I think when it comes to enabling transactions, you have these great tools. I'm little apprehensive about them in the sense that they're all free. They are all enabling direct plans. So what if they go down? But mutual fund structure actually saves you by their very design from any such crisis. So enabling transaction may not be good enough. If you are unable to get hold of an advisor, maybe also consider helping yourself. But first and foremost, if you are able to get a good advisor, list the things that you would expect from him. And the first validation, first due diligence which you can do on an advisor is just evaluate him based on the questions he's asking. Because the advisor can advise you well only if he understands how you think, what your experiences has been, and what your goals and needs are. So if an advisor is advising you without asking these questions, I don't think he's an advisor. Prasanna Gururajan is asking that is the ups and downs in the stock market is dictated by foreign institutional investors? Yes, the ups and downs of the stock market is on a day-to-day basis is guided by almost everything in this world. Sometimes something weird happens and the market goes up or down. But I think in the long run, so by the foreign investors, for the domestic investors, for the political decisions, for the mess in the economy, or even sometimes it is hurt by a virus too, in a very genuine way, because the virus has caused economic disruption, which has created fear in the market and has caused economic economy to a brought economy on its knees, on a standstill. So stock market can be affected by anything, because the outlook of the stock market tries to factor everything in a rush, in a hurry. If somebody gets an inkling of something happening and the market realizes it, whatever will happen in the next 3 years will be reflected in the next 15 minutes. And so in that sense, market is a very advanced reflector of many of the things which can happen very distant in future. But and you have absolutely no control on that. So I think the only thing which we can control is that look for companies which will make more money over a period of time. And those things don't get affected. Think of any company which produces something, and maybe it is affected by this COVID-19 virus and the disruption and all that. But people will start getting into, buying cars again, and, getting their home painted, and, carpenters will get back to work and they will start buying the adhesives. The companies produce, products and services which consumers will buy, and in ever rising number in India. And because there are inputs to these, so the company's earnings get adjusted for the inflation. Wages go up, the input costs go up, so does the prices. And if the prices go up, company makes more money. So that is the basic premise for equity. And once in a while, some companies go wrong, they go out of favor, or they get their outlook for they become obsolete, or they become they become less competitive, and they lose the plot in the marketplace. So those are situations, the kind of mortality that we see in companies. But generally, that is the basic premise why one should be investing in equity. And so be focused on those reasons. If you are focused on these reasons where, some FI is doing something else is happening, oil prices going up, oil prices going down, these are vicious, plenty of noise in the marketplace which can affect it on a moment-to-moment basis. Keep away from that. It's very important to succeed in investing, to keep away from noise, and keep looking for many of my columns which I have, joked about all the noise, all the funny noise. that is being made. In fact, right now the optimism that we see in the market itself is quite noisy. In fact, the new expression that I came across, that many companies reported their earnings, which was negative. Their earnings went down, and all through the day the television was screaming that they have witnessed something called degrowth, as if it was not a decline. It is a variation of a growth. It is not growth. It is a decline. It has made less money. So don't get abused or misused or distracted by the noise in the market. It's not meant for investors. It's meant for traders or somebody else who is making a living out of that noisy thing. Ravi Kumar is asking that how Sensex is growing from March when most of the I'll just rephrase this. Why Sensex is growing since March? As point number one, most of the manufacturing industries are in lockdown over 3 months. Migrant laborers have returned to their homes and unemployed. Economy of the country is down for the past 4 or 5 quarters. Consumption and purchasing power is at its lowest. Is there any explanation? Yes, the explanation is that markets are crazy. The other explanation is that markets discount the future, and lot of businesses, market men think, the people in the market think that this is going to be temporary. This is going to be, most businesses will get out of it after 2-3 bad quarters. That is one of the reasons. Only a small part of the businesses which will be impaired or which will be hurt in a fairly permanent way. Migrant laborers will come back. The production will be restored, and in 3-4 quarters. And when migrant laborers, of course, no doubt that everything that you have mentioned has impacted the purchasing power, has impacted the consumption, on which our economy heavily depends. But the hope is that production will start, migrant labor will come back, and migrant labor have gone back to their villages. Their cost of living is lower there. They simply don't have to pay the rent, and they don't have to worry about the day-to-day, and they might have the support system. And all they have to do is they don't even have to pay for the shelter, and they will have a community there, and the cost of food, which will be the only requirement, will not be substantial. So in that sense, the market going up is basically a bet that we will be back to normal, and a good part of the economy will take time, but will get back to normalcy. And that is the explanation. And that explanation might be wrong, which means there is a possibility that this can linger for a long period of time. There could be, reasonably permanent shifts of the migrant labor. Some people might just decide that, was going to a city well worth the reason, was justifiable. Should they come back? I don't think that is, they are all in the realms of future, which is always uncertain. But I agree with you. And the reason why markets are upbeat is that they think they are optimistic. They think that things will be back to normal. So thank you very much. Today it was pretty straightforward. I picked up 20 questions which 20 of the important questions which came our way. It is not in a chronological order. We thought of questions which were of wider interest, and that is why I have been able to, not get distracted, look at the screen, and hopefully my answers were useful to you. Thank you very much. Till next Saturday when we come back with the helpline.